This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
So Eric, let's just talk some charts. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Now just go to our homepage, MacroVoices.com, and click on the red button over Harley's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a build of 4 million barrels. That was against consensus expectations of a drawdown of about 2 million barrels. So much, much bigger build than expected. Cushing, Oklahoma was the drawdown on the board, and it was a big one, drawing down 2.5 million barrels. That's really significant because Cushing is a physical hub where a lot of oil gets routed through. It's not just a statistic, it's a physical place, and if they run out of oil there, it really presents a problem. So we're going to have to keep an eye on that one. Gasoline and distillates, both great big builds this week. 5.6 million barrels on gasoline, 2.6 million barrels on distillates. Those were both quite a bit bigger than expected. U.S. production ticking up another 100,000 barrels to 12.9 million barrels. I really want to salute our listeners who are in the oil patch around the globe, both in the U.S. and elsewhere, for just amazing post-COVID recovery of this industry. So many experts told us there's no way we would ever get back to anything close to 13 million barrels. We're not there quite yet, but boy, we're just within a stone's throw of it, and I think we're going to get there. It's going to be very interesting to see if we can break to an all-time high and where that takes us from here. So congratulations to the U.S. oil patch for really pulling off a phenomenal job here. The biggest news, though, this week is EIA confirming OPEC Plus projections for a demand shortfall in the second half. I think I heard that on a podcast about a year ago that was coming. So between a much more bearish inventory than expected and overbought conditions to start with in this market, needless to say, a pullback of some kind is overdue and very much in order. But so far, the lesson of recent history in this market has been that pullbacks in oil have been shallower and shorter-lived than most people, including myself, have expected. So how much of a pullback we get, I don't know. Hopefully we can at least get back down to the 5- and 8-day moving averages, which are just below the market. I'd love to see a deeper pullback so that I can add more to my position, but I still think that we've got quite a bit further to go. This is the supply shortfall, the supply tightness that I have been predicting, and I was definitely several months, actually close to a year early on that call, so I'll take my lumps for that one, but I think it's finally upon us. There could be a pause if we really get the recession in earnest that a lot of people are expecting, but I don't think even in that case that it will last too long before we get to a supply-constrained market, which is where I think we're headed. And so I'm delighted to be releasing my docuseries this week because I talk in episode 3 quite a bit about the reasons I think we're headed toward a global energy crisis before this decade is out.
Yeah, on page 2, I have that chart of crude oil, and it just continues to stay in a beautiful new uptrend. That pullback that we had here in August was a perfect buy on dip, testing that 50-day moving average, and now breaking out a whole series of highs. We're just approaching now the 2022 highs from the third and fourth quarter in kind of mid-90s range. And so the question here is that going to have oil bump its head there? I think it does inevitably. We are overdue for just a little swing trade correction on the downside of oil, but at this moment, this chart is very bullish and old dips should probably be bought. We'll see whether or not we can get up to the $100 level this year. All right, Eric, though, let's move on to equities. And on page 3, I have the chart of the S&P 500. What are you thinking here on the markets?
The longer this market holds up, the less likely it is that our many macro bear guests will be proven right on their calls that the bottom isn't yet in on this bear market. Now, I'm still swayed by their macro arguments, but unless this market rolls over and rolls over pretty darn soon, I think it's time to face the facts that the market, the chart, is telling us that all of us bears just got the call wrong somehow. The recession that we all expected either didn't happen, or it wasn't as deep as we expected, or something. I don't know what else to say. I still think that the bearish arguments are very well composed and make lots of sense, but it's not what the chart's telling me is happening in this market.
Eric, my opinion differs slightly from yours because generally, and more often than not, markets go through topping formations rather than just create a V-top and just start selling in a violent decline. I mean, it did happen in March 2020, but it is not the more common thing. And so in this scenario, markets often retest highs, whether double tops or even create all sorts of topping formations like a head and shoulders where we temporarily could break to a higher high. It reminds me a lot of 2007, where in spite of the very ugly summer of 2007, the market still managed to make a higher high in October of 2007 before the real bear market began. And so overall, even if this market did muster up a breakout on the upside as we get through all this huge economic data releases, I think that the old rallies would be short-lived, and it's going to be much more of a bigger topping formation than anything else. Let's move on, though, to the dollar index. What are you thinking here?
Well, the jury is still out. I'm glad to see it didn't break over 105 to the upside, but this chart still looks strong, and an upside breakout isn't at all out of the question. So I'm in wait-and-see mode.
Eric, we continue to trade right along those 2023 highs. This is, I think, a huge overhead resistance. It's very simple in my mind. Dollar rallying, dollar strength is typically associated with weakness in risk assets and or vulnerability in them. And whether or not the dollar finds resistance here and consolidates is a big tell of whether or not risk assets can have another strong impulse. If for whatever reason dollar strength persists, and particularly breaking to a fresh new year high, I think that would be a warning sign to risk assets and shouldn't be ignored. Nonetheless, let's move on to that gold chart on page 5. What are you thinking here?
1926, the 200-day moving average on the continuation chart, is critical support on the gold chart, and it was just a few dollars below the market as of Wednesday's close. If it doesn't hold, a deeper correction is entirely possible, and that would fit my general outlook that inflation is likely to persist. The Fed is likely to hike rates higher and longer than most market participants expect. If 1926 does hold, and particularly if the Dixie reverses lower as well, it's possible that the bottom of this correction is already in. But frankly, I doubt it. My base case is that the Fed will hike rates longer and higher than most people thought possible, and then they'll eventually give up, and at that point, gold's going to go to the moon. But I think that's a 2024 story at this point, probably not a 2023 story, but a geopolitical escalation would be the caveat that could turn that around to the upside. So there's lots of levers to consider here, but one way or another, I think in 2024, if not sooner, we're going to move to new all-time highs.
Yeah, the only issue I have with gold right now is that it truly continues to just simply behave as a cross currency to the US dollar. I know it's rate sensitive, but you can't deny this inverse correlation. And right now, what we're seeing is the US dollar strong and almost all cross currencies continue to be weak and sluggish. I think that correlation will dominate. And I feel that the next really strong period of gold, very similar to your view, is going to come when we have an easing cycle maybe next year and the Fed has to pivot and go the other direction. But until then, gold is a very weak chart in a downtrend, and it would not shock me if we had still more weakness to come on the very short term. In the bigger picture, though, I'll agree that will all come to a big buying opportunity. It's just all about the timing of it right here. Moving on, though, I wanted to just touch on a couple more charts here, Eric. The first thing I wanted to touch on is this chart of the seasonality of market volatility from equityclock.com. And what was interesting here is that we are right now in mid-September entering a period where historically the next few months end up being very volatile. And that's often many people can recognize that typically September, October housed many previous market drops. And what's interesting is that we're in a period now, though, as Harley alluded to, where volatility premiums are very low and cheap, and you could buy hedges at historically low levels. And to just kind of reflect on that, on page 7, I have the VIX chart, which continues to trade at multi-year lows. You have, though, on page 8, the crude oil volatility index. And this is what I find amazing, is that we're trading right now as well at multi-year lows on oil volatility. So even though oil's having this great rip to the upside, the optionality is very cheap to continue to trade and put bullish positioning on the upside that way. Similarly, on page 9, we have the gold volatility index as well at multi-year lows. And so it is so cheap to hedge here and to bet on long volatility, whether it's hedging or whether you want to just play long vols through straddling these different markets. The volatility and the Vega upside is definitely looking like it's asymmetrically skewed on the upside. Finally, I wanted to just touch on page 10 here, the high yield bond ETF. I know Harley was referencing all these credit spreads and so on. So on page 10 is showing just a trade range of the high yield bonds, which is surprising to me considering every other bond market has been in a clear downtrend. Similarly, though, on page 11 is that chart that Harley was referring to in terms of the option adjusted credit spreads, also at a year low. But yet on page 12, I found this chart on the internet, which is showing the U.S. non-financial corporate net interest costs, that being at their lowest in 60 years. But what it's interesting about is when overlaid with the Fed funds rate, it's trying to show that typically the uptick or the turn up in these interest costs tend to be associated with a substantial lag against the Fed funds. And so usually the Fed is already done its rate hike cycle by the time we start seeing an uptick in this. And this is the interesting part, is that whether or not there's one more rate hike coming in November or not, we are probably much closer to the end of the rate hike cycle than we were to the beginning. And inevitably, when the Fed will be forced to pause raising rates, the question is, what is going to be the lag time before we see these interest rate costs come? And it's either going to come with stresses on corporate profits, and eventually, as all of these shorter dated junk bonds need to be rolled, they're going to have to be financed at higher and higher rates. And this will trickle in inevitably. And the question now is this going to be a 2024 story?
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.